Okay, the DuPont identity, this is my favorite identity. I've used it quite a bit, so I'm gonna go over it and I'm gonna talk about how I've used it. So the idea of the DuPont identity is we have return on equity. And we're looking at return on equity between a couple firms, and you might say, well, you know, this firm has a higher return on equity, or we're looking at it over one firm over time, and you're like, why does this firm have a higher return on equity than another firm? Or why has this one firm's return on equity been increasing over time? So what the DuPont identity is going to allow us to do is to look at what is the driver of this particular firm's return on equity. And the reason why is return on equity can be affected by leverage. So we're going to sit there and go, did they just use more leverage? Or are they operating their firm more efficiently, using their assets more efficiently, or are they controlling their costs better than they used to, or better than another firm, right? So that's going to be the importance of return on equity. The DuPont identity is to break apart return on equity and to see why. Is it something that we don't care about, or is it something that is where the management has done right? So the idea is we can say return on equity, this is net income over equity. And what we can do is we can say, okay, well I can multiply anything by 1 and it's unchanged. So if I multiply it by assets over assets, then it's still return on equity because that's 1. And then these are real numbers, so they commute, right? So I can commute. So the idea here is this is net income over assets, assets over equity, right? So the idea here is this is ROA times the equity multiplier. And this is when this isn't the DuPont identity yet, but we get our first important result. So what we can see is return on equity is simply equal to return on assets times the equity multiplier, right? Now again, I don't really, if I'm evaluating a firm, I don't care if they've increased their return on equity simply because they've added debt. Anyone can add debt. If I want to add debt, I simply sell debt and buy back stock. This is a capital market transaction. I can call my investment bank and do that this week, right? So the idea here is if one firm has a high return on equity simply due to additional use of leverage, this isn't management operating the assets efficiently, right? So I'm not saying, so this is why I say I care, I might care about this less. What the harder way to increase return on equity is to actually use your assets more efficiently and control costs, right? So this is an important aspect of it. One thing I should say is I generally talk about increasing leverage is going to increase your ROE. Theoretically, you could increase your leverage and then your interest payment goes up so that ROA declines. So there is a scenario where return on equity could decline if you increase leverage, but it's unlikely. More than likely, you're going to increase ROA. All right, so further we can break this down by saying, okay, well, this is equal to, let's say, net income over assets, assets over equity, and then I can just multiply this by sales over sales, right? So then I'm going to get here, commuting, net income over sales, sales over assets, assets over equity. Right? So now this is our DuPont identity. If you remember from our financial ratios, profit margin times total asset turnover times the equity multiplier, right? So this is equal to profit margin times total asset turnover times the equity multiplier. And this is our DuPont identity, right? So now what I can do is I can further say, well, let's say a firm, we're looking at one firm and its return on equity has increased. Well, let's say they haven't changed their capital structure. So now I can sit here and say, okay, well, is the increase in return on equity due to them holding down costs? That's what profit margin is going to tell us. Or are they using their assets more efficiently, right? That generating more sales per unit asset, which would be total asset turnover. So the idea here is we can, the idea of the DuPont identity is to break return on equity up into a measure of profitability, so we can tell whether the change in the return on equity is due to profitability, asset use efficiency, or simply capital structure. Now, I mentioned I've used this. I have actually used this. It is one of these things where I never actually thought I would use it, but we were looking at drivers of profitability on wind farms. And these are subsidiaries of our own company, so we don't have any market-based measures. You can't look at the stock price, right? But I did have financial statements and capital structures for the wind farms. So I realized I could do a DuPont identity, right? So I did a DuPont identity for these wind farms and realized that the driver, okay, the driver's asset use efficiency. So I've actually, this is one of these things where I've actually used this. It proved very useful in that scenario. So again, I find it to be very important. Good. Well, I hope you found it interesting. Have a great day.